Okay, today I want to talk to you about an approach to trading that I think is so important to your success and longevity in this really difficult world of trading. And this is especially true if you're trading prop funded accounts, or maybe you're looking past an assessment with a view to trading prop money, much larger capital than you may have traded in the past. Trading larger capital has many more considerations and complexities that you should be aware of. So you need to take it maybe a little bit more seriously. Have you ever thought how the successful traders that are trading this large capital, how they mitigate their risk while maximize their returns? Well, if that's the case, this video is for you. So buckle up, let's get into it. When you diversify across various asset classes like the forex market, stocks or commodities, we can significantly mitigate the risks associated with volatile markets that maybe decide to range or reverse, so that you're not going to be putting all your eggs in the one basket. That's basically what diversification is all about. This approach will not only help you minimize the potential of loss, but it also optimizes our returns over time. Diversification allows us to capitalize on different market opportunities without having to rely on just one trading instrument. Now, I've seen traders over the years that focus on just one entity, and that's okay for them. It has its advantages, getting to know the intricacies of that particular entity. But if the volatility dries up or the conditions change, the strategy you're using may go into a period where it just basically doesn't deliver and you're wasting all your time. Think of the opportunities that you'll be missing out on. If you're a trend follower, one particular asset class, maybe the euro against the dollar in forex, and that then goes into consolidation, you're going to tread water at best, but possibly bleed the account at worst. There's always markets in trend, and there are always markets that are consolidating, and diversifying allows you to always be involved, looking for your trade setups. We need to be adaptable to find the opportunities. Having a diverse trading portfolio keeps us ahead of the game, provides us the flexibility we need to adapt over the ever-changing market conditions, and they are always changing. Diversification equips us with the tools to manage risk more effectively. But you need to be aware of the pitfalls, a critical aspect that you need to avoid when diversifying, say in the forex market, is the correlation. Most currency pairs are correlated in one degree or another. Now, most traders out there, I think, certainly the novice traders or the rookie traders, they're unaware of this huge correlation, both positive and negative, that does exist in the forex markets. Trading pairs that move in tandem, the same strategy can amplify the risks rather than mitigate it. Now remember, we want to diversify to mitigate the risk. Did you know, for example, that the US dollar basically equates to about 88% of all foreign exchange transactions? Pretty much what happens to the dollar has an impact on all the other currency pairs. So if, for example, say you're a trend follower and a setup presents itself in the pound against the US dollar, and you take your long trade, that basically means you want the pound to go up and the dollar to go down. You're buying pound dollar. Then you have another setup that might be, say, in the New Zealand against the Canadian dollar, and you buy that as well because the setup appeared. Did you know that these currency pairs at this moment in time are pretty well correlated? Look at this. Okay, so what we're going to do now is look at TradingView, and here on the screen I've got the pound against the US dollar. Let's assume now that we've got a buy setup triggering and we want to go long the pound against the dollar. Well, now let's look at that compared to the New Zealand against the CAD. And the way to do that very quickly, going to this little plus sign in the top left of the screen, click on that and look for the New Zealand CAD, pop it on, and there you'll see the two together, and you'll see the correlation between these two currency pairs. See here, as the pound goes up against the US dollar, so does the New Zealand go up against the Canadian dollar. And as it turns at the end here, so does it turn at the end here. If you're long the pound against the US dollar and the New Zealand against the CAD, and it turns, chances are you're going to get stopped on both. You need to know that. And another way you can look at correlation is by using one of these tables, which basically maps out the correlation in terms of numerical numbers, different time periods as well. And you can see how well they're correlated or not. But as I say, I've done a video on forex correlation. Stay to the end and I'll link it to this one. So you should focus on currency pairs that have low correlation if you're diversifying. Now, I've done a complete video on forex correlation and I'll link it at the end of this video, so make sure you stay tuned. Using multiple trading strategies is another way to add flexibility to your trading, whether it's trend following or reversion or breakout trading, range trading. Having a mix allows us to adapt to different market conditions much more effectively. Now, at the City Traders, for example, I teach a number of very simple trading strategies which can be deployed in different market conditions. Now, I call these the boomerangs. One is a boomerang trend following strategy. The other one is a boomerang reversal strategy. Boomerang basically meaning it should come back at some point. Trend and indeed counter trend. Now, I suggest when using multiple strategies that you may want to use different time frames as well, so it doesn't mess with your mind. So for example, you may want to consider using a trend following strategy on the higher time frame and maybe a reversal on the lower time frame. That way you can capitalize when the markets want to change direction. You're not going to be chasing your tail or chasing the market. Now, when I say multiple strategies, I don't want you to overkill this. 2, 3, maximum 4 strategies is plenty enough. And make sure, of course, they've been back tested. Make sure they've been written down and have a checklist as well to keep you controlled. Wise capital allocation and risk management. Setting risk limits on each trade based on percentage risk ensures that no single position disproportionately impacts your overall portfolio. To ensure long-term sustainability, traders should always consider risk at the forefront of their trading decisions. It's not all about hitting the ball out of the park on one trade. You may have been following me over the years. One of my most watched videos here on YouTube is one of those that talks about the law of large numbers. Let the edge play out over time. I personally recommend that you don't risk more than 0.25% or maximum 0.5% per trade. Sure, that's not going to give you the windfall cash payout. Doesn't suit the smash and grab trader. But if you want to go and tell your boss to go and jump in the lake and become a career trader, this, I think, is the approach that you should be taking. This disciplined approach helps managing potential losses and helps preserve capital for future opportunities. And finally, combining technical analysis with fundamental analysis provides a much more comprehensive view of the markets, allowing for better informed decisions. You know, trading is all about exploiting an edge over time. No one can actively predict the future, but when trading that edge over time ensures that you will come out on top. And when the fundamentals align with the technicals, it makes for a much stronger probability, increasing your edge. And always remember, staying educated and disciplined is key to optimizing returns and managing risk more efficiently. Diversification isn't just about strategy. It's a mindset that positions us for long-term success in the markets. So there you have it. Diversify the assets that you trade. Beware of the correlations when trading the forex markets. Use a number of strategies for varying market conditions. Use wise risk management and keep an eye on those fundamentals and never stop learning. We're always in a continuous state of education. Now, as I mentioned, I have made a video on forex correlation. I suggest you go and watch that now. I'll leave a link here on the screen. I also suggest exploring the channel where you'll find lots of trading strategies that you can use for these different market conditions and some risk management videos as well that I've made in the past. There's tons of value on this channel. So make sure you subscribe. And if you want to learn how to trade and eventually get funded, why not join us in our trading community? Check the link down below. It's all there on Discord. I hope you like this video. As I say, give me a thumbs up if you did, give me a thumbs down if you didn't. Let me know your comments. I always like to read the comments from my followers. Okay, well, that's about it for now. Thanks for tuning in, and I'll see you very soon.